What's going on, everyone? My name is Nicholas Merton here from Data Dash, and today is September 27th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to answer the big question that's on everyone's mind at the moment. When do I buy Bitcoin and broader altcoins in the crypto market? When is going to be the price tag or time to go long on these assets? And I think that there's a lot of people who are telling you right now to go long on these assets. I think for those of you who are looking for a more fresh perspective and one that may be a counter to the broader narrative, it may be valuable for you in your investing journey. So I thought I'd spend some time to talk about that today. We are going to be mentioning some price levels we're watching and some rough time frames, but we're also going to be understanding the fundamental factors that are going to allow for crypto to eventually move higher, which are essential to understand. If you guys happen to enjoy my rambling, consider dropping a like. This is a video you guys won't want to miss, and it's a great way where you can support the channel by liking the video. And let's go ahead and kick off the rambling. All right, I want to go ahead and start here by talking about the fact that right now Bitcoin is in a relative no trend at the moment. If anything, it's starting to signal that the uptrend or bull market narrative is likely starting to fall under its own weight. We are at the same price tag we were at in the mid-range of March 17th. So we've been here for over half a year now at around this 25 to 32K price range, and now we are at the lower band. We have broken through the ascending line of support. We faced resistance at prior support from the last bull market. All of these things are indicating that we're likely moving lower, hence why we have the position we have. But let's go ahead and talk about what's going on in the broader asset markets. We can see that Microsoft itself is starting to move lower here. As you can see, we're utilizing our key momentum tool, which is something you can get access to within the Dash report, our newsletter here on the channel. It's our custom indicator here that tests for momentum, and it comes with a pivotal line so we can see when that trend change is happening. On the daily time frame, Microsoft has flipped, but more importantly here on a lot of these names, we've seen a clear red flip on the weekly for the first time since really back here in November, December of 2021, or back here in the collapse of the relief rally during August of 2022. So the AI narrative and all the buzz around Microsoft and these stocks entering into a new bull market is starting to fade. We can see the same thing here with Apple. We spoke a lot about a potential deviation here above the line of resistance and a potential target of Apple coming down here to 80 to 90 bucks. Again, a very clear red trend flip, the first time we've seen it since back really in September or really back here in April as some of these leading technology plays started to fade. I don't want to spend too much time on this, but you guys can see very clearly here that the trend is starting to wane here. The FANG stocks look overextended and exhausted as we've essentially cut back here about over 3 months, 3.5 months of price appreciation for these technology companies. So this is not a good look here. Essentially, we're seeing across the board in the stock market a lower relative high versus what we saw back in March and February 2022. We were not able to clear through the relative highs here for the total stock market. So we're taking a look at VTI and are moving lower here from our relative highs in July from the summer. And the VIX, the volatility index, is picking up big steam here to the upside, meaning that volatility and uncertainty is picking up as markets are starting to price in a future where things are essentially either heading towards one of two things, either a near-term recession that will be dealt with properly or long-term inflation. I'm going to go here today and share my personal opinion of what I think is actually playing out here. I think there is a very good chance here that we may just be seeing a typical textbook recession. I want to mention here and make very clear that we are discounting the potential of a soft landing. Folks, I really don't want to be rude here. I respect everyone's opinion. There are a lot of people out there I admire to a degree and I listen to as well when I'm doing my own analysis that may disagree with me on this. But at this point, after the recent FOMC meeting, or let alone the past FOMC meetings over the past few months, if you're not getting the picture here, if you're not seeing it in the charts we're going to discuss today, we're not going for a soft landing. There's no easy way out of this, unfortunately. There's either going to be a mild recession or an extended depression. And I'm here today to, again, not be overly bearish, overly doom and gloom. I think that a common recession is what's going to play out here. The unfortunate reality that many people haven't faced is that Bitcoin has not lived through a recession yet. We can see here that there is further de-acceleration in some of the minor stocks for Bitcoin, for example, that have collapsed from the relative ETF highs of $19 back in July all the way down to less than $9 per share here. More than a 50% correction in just a few months. Whereas these ETFs and these plays on Bitcoin and crypto as a whole can rise up at a pretty rapid pace, it can also de-accelerate just as fast. And this is not bull market activity. If I'm just being candid with you guys here, right? A lot of people will tell you it's a bull market, just buy the dip, dollar cost average. The unfortunate reality here is that you may be dollar cost averaging way too high, and that Bitcoin is going through something that it's never experienced before. Bitcoin has never been through a proper recession. It has never gone through a full waning recession. I think that since back here in November 2021, Bitcoin is going through its first recession, and there are going to be deceiving relief rallies along the way. So you guys kind of get that picture if you watch the channel routinely. I want to get down to the bottom of it here. What are we looking for here in order to go long Bitcoin? Is there some specific Bitcoin data science model that we're turning to? Is there some kind of concoction or certain specific resources that we're leading into? Well, there are some charts here, but they don't have to do directly with Bitcoin. I care more about understanding here at the end of the day is I understand that Bitcoin is a growing global asset and it is dependent, even though Bitcoin may be some asymmetric asset, even though it has a cap supply, even though there's the halving event and a Bitcoin ETF and yada, 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 all the narratives that people can toss at you. At the end of the day, I want to bring you guys back to center because the fundamental reality is that Bitcoin goes up when people have disposable income. And when we're heading into a recession, disposable income, i.e. the money you make from your job that you don't have to spend on routine expenditures, that you could put away in savings, you could go and invest in various assets, right? That disposable income is going to be incredibly scarce. And we need to set realistic price targets, we need to set realistic time frames, and we need to understand which economic indicators are going to help us understand when that capitulation is set in, where disposable income is going to be dried. And the reason I say that is because at that moment, when we essentially go through that peak pain, that is when prices usually find a bottom, because afterwards it starts to get better. And institutional investors set their bids at those types of ranges in order to build positions before the next run up. Okay, so let's go ahead and try to understand here, what do we need to see before we can really expect the number to go up and to the right like many people are calling for? Well, first off, we got to get back towards the unfortunate, brutal reality here that I know is boring, I know most people don't want to talk about, and that's inflation. Let alone having to think about inflation. Inflation is a painful thing. It makes us all feel a little bit less wealthy or rich comparative to where we were, say, a year ago when our money can't buy as much as it used to. Well, a lot of people believe that the fight in inflation is over. So many people have echoed the point here, whether it be narratives like, the Fed has already done the job. There's, for example, delayed effects from the Fed's tightening, that 3% is the new inflation rate, all these rationalizations that the job has done. Therefore, it's, my eagerness to go buy assets is justified because the Fed's done its job, and we gotta be ahead of the curve, right? We don't want to buy too late, right? When things are too bad and the smart money is already going to be in. No, it's time to go long. That's the narrative that so many people are sharing right now. That is not where I stand, guys. I'll say it candidly here, and there's good reason for it. Historically speaking, I don't know where people are getting this idea that 3% is the new norm. At the end of the day, the Fed is continuing to head towards its 2% target. It is continuing to tighten interest rates. It's continuing to reduce its balance sheet, as we'll take a look at here in a little bit. And its goal is to get below not only just 2% inflation. It's not a job of just getting it to 2% and then, okay, we can go back to printing money and stimulating the economy again and lower interest rates to 0%, even if something breaks. That's the problem here. People, unfortunately, have not faced the reality. So many people in the market are not facing the reality that this needs to not only get to 2%, which we are still a far cry away from after the past 2 months where we've seen a bounce from around 3% to 3.7%, which is just, again, showcasing the Fed is not doing enough yet. But outside of that as well, we not only need to get to 2%, but we likely need to get somewhere in this basket range between 1.5 and 0% inflation. Some may even argue we need to have negative rates or deflation like we had in 2008. I don't know if I want to go that far. Again, I think that would again show that the Fed is really, taking on inflation. It's going to get it done with, and we can have a decade of prosperity afterwards, and hopefully many decades without rampant inflation if monetary policy is managed properly. But I got to tell you guys, if I'm just turning towards history here, these are the type of levels that essentially when we have pullbacks in the economy, like in the 80s, or here, right, as we go in towards the dot-com bubble, or if we come here into the early warning signs of 2006 and eventually into 2008, 2009, we can see that these are the types of levels. Here in 2015, the mid-cycle correction where there was a commodity crisis in the world. A lot of people believe that China was entering into a major growth recession. And also here in September 2020, or excuse me, June of 2020 or May 2020, following the COVID crash, right? So this is the kind of ballpark where we usually find recessionary bottoms. And outside of that as well, it's a kind of percentage that says, hey, we're going to have a few months where there's no inflation. We are really going to cripple growth here in the short term so that we can get inflation dealt and done with, and we can hopefully move up to the upside. That's the period of time here. If you guys would have bought US stocks in April of 2022, if you would have bought stocks in January 2015, if you would have bought stocks in the recessionary period here in January of 2009, you'd be getting practically close to the bottom in all asset prices. And from there, the work is easy. You can dollar cost average. You can take more and more risk, albeit don't take too much risk. You gotta have balanced measurements there because there can be corrections. But you get my point here. You can passively DCA. You can go all in on those sectors that are going to be the top performers because you know at that point that the Fed can start to provide some kind of monetary support. Unfortunately, now we are far away from that. So again, first off, the key ticker here, point number one, is that inflation is still far away from where it needs to be. It needs to likely get into this band of 1.5 to 0%. And the longer it stays in there, the more confidence you can start to have in DCAing into Bitcoin, into US stocks, any plays that are showing signs of confidence in their price action. And I'm not looking for just the most beaten down plays. I'm looking for, again, those cryptocurrencies that are leading during that period of time, during peak fear. Right, which ones are resilient? Well, first off, the next thing we have to talk about here is, second off here, we got to take a look at is the labor market. Okay, so inflation is only really going to go down if two things happen: if the cost of goods and services go down over time, and unfortunately, in pairing, it usually tends to be that if the job market is cooling down and wages are starting to cool down. Now, I understand here at the end of the day, as much as the next guy here, I want people to be paid fair wages. I'm not here to call for the economy to collapse. I'm not some gold bug or silver bug who wants things to be totally doom and gloom and the next year things are just gonna be terrible, right? There's always people like that. I'm more of a pragmatic optimist. I believe in the long term, while there's problems in the world, things are gonna get better. The quality of living is gonna get better. And sure, while we have our issues throughout time and stuff, they can be properly addressed and dealt with. What I'm addressing here is the fundamental reality that our economy got overextended here. And we can see it if we really look at the long-term trend here within the JOLTS data. This is the job openings within the US. Now, I'm speaking from a US perspective here, but you look across the world in many places and you're going to find a relatively similar story. In the US here, we had a massive amount of jobs created, even if you take it here from before the pandemic in 2019, whereas we had around 7.4 or 7.5 million job openings here at the relative peak. We went all the way up to nearly 12 million job openings. Now, these are jobs that are available in the economy that companies have put out on the open market that hopefully they're looking for someone to fill in that role. Now, this speaks towards a really important story of what happened. Right? And it's beyond a story of just analyzing unemployment because we have seen this number go down here. This is one of the Fed's metrics. We needed to see less job openings in the economy because that means a less competitive job market or essentially companies are not fighting for the same labor pool as much as they were before. Simply put, this is going to mean that there is less need to offer extended income benefits or basically payment packages for any new hires. And essentially there's, essentially more of a labor or company advantage when hiring, right? Again, I'm not here to say good or bad. I'm just here to say that this is something that the Fed has called for because they need to suppress not only the inflation of goods and services, they need to suppress the inflation of wage inflation, right? So essentially the good news is the Fed has come a long way in doing this, right? We've come down from a little under 12 million all the way here towards 8.8 million and the actual numbers, much below the forecast here. So we are starting to see a deacceleration of this. However, again, if I were to give a ballpark figure here, we likely need to be somewhere here between the COVID lows or somewhere up here where we were in around 2019. somewhere across from this figure of around 6 million, around 5 million, up towards 7 million. I would say a ballpark estimate here is when we get below that 7.5 million figure, this is a positive sign here that inflation is being dealt with and that inflationary effects from wage inflation are going to start to cool down. This is, again, what the Fed is going to be looking for here, I think, towards a large extent, getting it back to where it was back in 2019 or somewhere here around 2019 to 2020. The second thing here that we have to take a look at here is unemployment. And I'm going to come back here to this topic of this kind of labor market as a whole. But essentially speaking, we are going to need an acceleration here in unemployment. I'm not saying as dramatic as, where we were back in April of 2020 when everyone was being forced to be laid off, and I don't think anyone wants that. And I'm not even saying it needs to be as bad as, say, here in 2008, 2009, and maybe even some of the prior recessions in the past. It could be something much more modest, as the labor market has been pretty resilient here. Essentially speaking, we need to at least see unemployment here probably above the historic norm of over 5%. As we see throughout history, when you get above this 5% mark, that is likely when you have more modest recessions, that's when at least you're starting to get towards the capitulation phase, where you're starting to get into cooling environments. And it's no surprise here when we take a look back at, say, here from the 2000s to 2003, or here from February 2007, up here towards February 2010. When we come back to that inflation reading, you will find during those periods of time that we also see corrections in inflation. Because we're not only seeing less economic spending in the economy, you're seeing less wage growth. The labor market pool starts to expand, and you have more people who are willing to return back to work. This is the big problem, guys. This is the problem with the current rate of time we're living in right now, where essentially so much money was printed in the economy. And even with the inflation in the cost of goods and services, there were a lot of people who made what I call dumb money. Money that you didn't have to work for, money where you simply made it through financial assets. And unfortunately here, I understand this kind of hits close to home here in crypto. A lot of us got some of that dumb money. At the end of the day here, I'm not here to insult crypto, but more specifically that the Fed printed a lot of money. And not everyone is effectively a real millionaire. We might have felt that way here. We might have felt like Jordan Belfort, or we were some really smart investor, but we really got lucky here at the end of the day because the Fed printed a ton of money. And if you were early to that, you made a ton of money in the process. The unfortunate reality is that we're coming back down to essentially square one. We're getting rid of that excess liquidity in order to get rid of this inflation that's really hitting the everyday person most of all. And now we can see that there is a re-entrance of people back in the labor market. You saw a significant reduction here, about 63% to 60%. And this left a huge anomaly in the economy. You're talking about 3% of the labor force in the United States was no longer participating in labor. Well, that started to rebound here towards more moderate levels. But we're still from prior here towards the collapse, down by about 0.5%. If you're talking about the United States, which has 333 million people, you're talking about millions of Americans here that are not participating in the labor market right now. And that's even considering aging demographics. So I think most likely the Federal Reserve, in order to tame the wage inflation and to get things back, and also, of course, to get us towards a point where Bitcoin is going to be capitulative enough here, we're essentially going to have to see labor force participation back up in this range here, somewhere between 63 to 63.5%. Once we get in that range, I'm going to start getting really interested here. And outside of that as well, we got to get back to the fundamental reality here, guys. And then we're going to start talking about some price points. At the end of the day, following liquidity will give you so much of the story here. Just this week alone, analyzing the Federal Reserve, we had our biggest week-over-week decline from September 11th to September 18th. The week, in this period of time, we had the biggest decline in central bank liquidity for the United States ever since we started this pullback, since back in April 2022. Over nearly $75 billion in 1 week removed from the Fed balance sheet. To put that in perspective, that 1 week, we reduced the effective central bank balance sheet by a percentage point. It may not sound like a lot, but we're essentially removing 1% of the entire stimulus effort that the Fed has injected and built up over the last secular bull run, the last decade. And that looks like it's steadfast to continue. We've corrected that balance sheet by about 10% here. And as we have indicated for a long time, we think either one of these ballparks is where we're heading. We don't know how long it's going to take, but the Fed has got a long way to go here, and the line is coming right down into this pocket here. Now, perhaps something breaks. Something leads the Fed to pause, but I got to tell you guys, the idea that something is going to lead the Fed to just printing money again, wouldn't bet on it. We had what almost was an entire break in the banking industry back here in March. What could have been a massive period of contagion, where unfortunately the FDIC had to go above and beyond its normal coverage rules to cover hundreds of billions of dollars. And the Fed only printed a few $100 billion here, a blip on the map, which was later corrected through future tightening, as these banks are battering down the hatches, so to speak, to prepare for a recession. So again, somewhere in this ballpark, which I think we're going to reach here by either the end of this year or in early Q1 of 2024, that could be a window of time where maybe we've had enough tightening, where we've started to reach some of these more moderate levels, like 20% or 33% reduction, essentially cutting down that secondary wave of liquidity injection from the later part of 2020 into 2022. However, we come back here to the topic of global liquidity, and I think we've got a long way to go here. I think overall, considering the continued reduction in the Fed balance sheet of a couple $100 billion and other central banks across the world, I think we are definitely coming down here somewhere between where we are now and the relative resistance range in 2018, somewhere from 20.5 trillion up towards around, say, $22 trillion before the job is done. And that, from that point on, is either 3.5 trillion or $2 trillion. $2 to $3.5 trillion in liquidity reduction. It still needs to happen. So we are a far cry away here from that. But again, if the momentum keeps playing out as it is now, if we continue to correct here, right, we're looking to possibly get there by sometime in Q1 of 2024 if central banks do it right, if the Fed leads the charge. Now, we spent a lot of time talking about macro here, guys. We talked about a couple things. We first off talked about inflation itself needing to get down below 1.5 to 0%, somewhere in that range, and the longer it lives there, the better. The second thing we looked at is unemployment getting above that 5% target. We took a look at labor force participation, getting it up, if I remember the number correctly, around 63.5 million. And outside of that as well, we want to see global liquidity reach levels of certain parity where we can start to have real capitulation and finally start to get buy-side opportunities. However, here for Bitcoin, I want to go ahead and let you guys know what my thoughts are here. So we've mentioned some general timeframes. We've talked about the kind of close this year towards 2024. Likely, because of this relief rally we've had, it is delayed the inevitable, in my opinion, that we have more correction to go. We have lower prices. It should have happened last year if the Fed was more direct in tightening, but unfortunately, we didn't do that. And because of that, there's going to be a lot more people who are burnt. I think in many ways, as we wrote about in the Dash report, this is a part of what we call the liquidity trap. We even talked about it here on the channel, where essentially the Federal Reserve is using financial markets and speculation as a way to get money out of retail investor hands, money that can actually then go and be spent in the economy in excess degrees than usual, versus institutional capital, where when someone who's got $100 million makes a couple extra million, stealing it from retail traders by out trading them or getting them liquidated or whatever, they're not going to go out and buy tons of Lamborghinis and additional things that they weren't already going to buy. Right? It's again about getting back to supply and demand equilibrium. If you guys are interested more in that concept, I can talk about the liquidity trap a bit more, but I'll leave that for another time. If you guys want to see a video on that, feel free to drop a comment down below. But let's get down to business here. If we're looking realistically at Q1 of 2024, if we were just to keep the current trend direction we're at right now, somewhere kind of in that moderate trend, right, to get there, we are likely going to be somewhere in this pocket here. We're either going to be between some of the relative highs here of 2018, which served as a foundation for a bounce in June of 2022, here in December of 2022, and also here in January 2023. And along with that as well, the resistance from some of the bear market ranges here in 2018, in 2019, and early 2020. That is through a ballpark range of around 12K up towards 17.5K. The most optimistic scenario, I think, here being a double bottom for Bitcoin that could lead towards reacceleration higher later on with the prior lows here at around 15 to 16K. That is the earliest that I'm really feeling about, starting to maybe dollar cost average here and build some kind of position. So at least I know I've got some Bitcoin, right, that I can at least bet on here if things start to go higher. However, I still don't believe that's going to be the scenario here that plays out. The next area that I think is much more likely is coming down here into this pocket, into the golden range, essentially coming here somewhere in this accumulation channel, this descending accumulation channel with lower highs and lower lows, where price generally has found buyers in the past. In this range that has allowed for future price acceleration. Now I want you guys to observe something here. I apologize for my crude drawings, but I'm just kind of trying to make a point here. We can see each and every time that not only prices come down into this descending channel, right? But on top of that as well, the buyers were not able to kick off a new bull market or continue acceleration of a prior bull market when in these channels. So I would say that it is pretty conservative here to bet that we're coming in this range, and more likely, or at least something that we need to be accountable for here, is the idea that we could possibly come even lower than these levels here, down towards around 10K. I know it sounds crazy. We're at 26K. People are talking about a Bitcoin ETF. How could it even happen? I promise you guys to be of the mindset the unexpected is going to happen is likely going to be the successful mindset here going into the next few months and the next year. Bitcoin has never been through a recession before. And the unfortunate reality here is that liquidity is relatively scarce in this market. I'm not saying you need to wait till all the way down here. What I'm saying most importantly is that you need to be modest in your expectations here. And I'm trying to give what I feel, albeit may be a bearish case scenario, at the same time is at least one that's rooted here in the fundamental reality that liquidity is drying up. And that at the end of the day, Bitcoin may not be the leading asset over the next few years. I promise you guys here, look no further than gold over the last decade. We do believe there's a chance maybe gold could accelerate as it is making higher lows here. But what I want to focus on is more specifically, if we take a look way back here in 2011, we can see that gold has been practically break even from the all-time highs. And even if you bought here on a dip during this period of time in say 2013 or 2016, you're barely up compared to the performance of equities, which did much better during that period of time. Now, gold is a much bigger market. I'll admit that. But at the same time, our expectations that Bitcoin is going to become global money, all these things, yada, yada, there's no guarantee of that at the end of the day. We may think it's really sound money. We may think it's the best thing since sliced bread, but may mean that there's not the risk appetite for other investors out there that it is for us. What I mean by that is that Bitcoin may not meet our expectations, and it's important to not just fall in love with one particular asset because we like its properties, or we like the narrative, or we like holding it. At the end of the day, don't be 100% all in Bitcoin. And outside of that as well, keep a modest expectation about when those lows are going to be formed, and more importantly, when the new bull market's going to come. You may end up buying the perfect absolute lows. You may be buying in the kind of accumulation channel for that matter, but be ready to understand that Bitcoin doesn't guarantee you anything. It isn't going to go up right away all the time. So I understand Bitcoin has had phenomenal performance here over the last decade from 2010 to 2021. But essentially, I was during a period of time where it had much greater growth multiple potential. The halving of it had much more of an impact. Bitcoin had much more Fed and central bank liquidity supporting it. Over the next couple of years, it may not be that we enter back into that environment, even considering the decline in demographics and changing macro factors, where the Fed may need to step in sometimes. They probably are not going to step in so aggressively in order to get inflation back to a modest target and make sure that it stays there. So these are some kind of ballpark estimates here that we can watch for here. Essentially, I would expect that if we really do continue to pull back here, it's going to be accelerated, and it's going to happen sometime in Q1. And that's where we could start to maybe find a good range where the risk-reward profile of dollar cost averaging, for me personally, starts to make sense. Another way to look at this as well, if you are in disagreement with me, but you've made it this far, I thought I would share this point with you guys. And something we talk about in the Dash Report group, essentially it's this concept of accelerated DCA. So if you feel, for example, right now, that we're kind of in. Generally speaking, I understand the concept of DCA at the end of the day is to not time the market, right? To do the most bare minimum is just to invest in the market time and time again, every week, every month, whatever. I'm here to challenge that and say that if you have some decent wits to you, if you're willing to take some degree of risk here, I believe in the concept of accelerated DCA. Essentially speaking, when we see from a given price point when you start a DCA program, and you feel that there is potentially more downside from here, you don't know exactly what lows, and you don't want to try to pick the absolute bottom. I don't blame you. Essentially speaking, you can set it where every time you get a 10, 15, 20% decline in price, or it can even be more modest levels, you get a little more aggressive with your DCA. So let's say each month between your income and you have some savings on the side, you want to allocate $500 for purchasing Bitcoin. What you can do is start off with doing $250, and you put $250 of the excess cash into a kind of essential pile or an area that's just, maybe you put it on your exchange account and you kind of wait to buy Bitcoin later on. Then you get another 10% dip. You're not only going to do your typical 250 DCA, but maybe you do $300 now and you take $50 from that additional cash pile that you put set aside. Essentially, as things go lower and lower, you go more heavy. And I think that this is a much smarter way to DCA rather than doing what, say, MicroStrategy did, where they ended up just kind of FOMOing, getting a lot of cash together and DCAing heavy here at the 30K range. Would have been much smarter here probably for them to kind of hold off, because it's looking like we're coming back at a minimum here towards this range. Hey, I could be wrong, but I got to tell you guys here, at the end of the day, the environment here is not looking very positive for crypto. And I would love to tell you guys otherwise. Some people unfortunately have this misconception that I benefit from being bearish here at the channel. And guys, I don't care about some views here on the channel. I care about maintaining a quality audience here. I care about informing you guys, most importantly, about what genuinely things happening in the market. And if you want to talk from a strictly business term here, we don't do better during bear markets. There's less advertising spend. On top of that as well, people are just generally more kind of risk off. And yeah, I'm not promoting my Bybit or Femax referral links and all the other leverage trading exchanges out there. There's a ton of YouTubers out there who will make money from liquidating you, or essentially having you get liquidated, right? Losing all of your money on a leverage trade, and they get a liquidation fee. And you may never watch them again, but they've made plenty of money off of you. I'm not about that here. Sure, we have ways of monetizing here, guys, but I'm not short the market right now. I don't have some huge multi-leverage short position on Bitcoin. I don't. And that's the fundamental reality here. I'm mainly in cash here at the moment. And I'm just here to show you guys that right now, this is not bull market price action. And the vital macro signs that we can analyze showcase clearly why that is. We have barely seen an uptick in unemployment. We still have a ways to go in readjusting the labor market. Central bank balance sheets have a ways to go before we really get back to some normalcy of where we were back in the past. And until we start to fundamentally realize that, and I think many of you are already realizing that, until we accept that, we can no longer be able to navigate this changing environment. A lot of people are thinking in the mindset of the last decade. And while I don't want to tell you exactly what to do, I recommend you take people's voice with a grain of salt at the end of the day, including mine, but especially those who aren't adapting to a changing environment, who are fixed in their way of thinking. And again, I only get here to my thinking here, guys, which is very different from how we talked since back in 2016, 2017. Because the fundamentals have changed here, liquidity is not on our side. And that may be an uncomfortable reality, but it's the truth. And I'm only going to be telling you guys what I feel is the truth here. Even if it's my opinion, it's going to be rooted in fundamentals that I can analyze in the market. And I won't always get it right, but I do my best. Well, if you guys did make it this far, if you did like this rambling, I recommend, if you guys want to support the channel here and get some additional content like that momentum indicator we talked about, like some of the analysis, like the liquidity trap, which we discussed for multiple months, and also this global liquidity metric that we showcased in the video. and featuring some other content, then I definitely recommend you guys check out the Dash Report. You guys not only will get a 20-page newsletter that's going to be dropping in a couple of days at the top of the month, but outside of that as well, you guys will get access towards our alerts group. You'll get access towards exclusive market updates. You'll get access to the Dash Report discussion group, our mid-month webinar. We package a whole offering there for you guys, and it's for the low cost tier of either $25 on a monthly basis or $240 or $20 a month. Where you guys can get 20% off if you sign up on an annualized basis. I'll leave a link down below in the description where you guys can check that out. It's a great way to support the channel as we're slowly trying to move away from being too dependent on advertising revenue here on the channel. But it allows me to do what I do here. And even if you guys don't want to sign up for it now, just keep it in the back of your mind. Maybe consider it in the future. And if you liked this kind of content here, the free content we put out here on the channel, and want to see more, definitely consider dropping a like here in this video. That also helps to support what we do and get it out to more people. But that's it for today's video, everyone. Thank you all for making it here this far in the video and giving me some time out of your day. I hope you make it a wonderful day, and I'm going to see you guys on Friday at 6 a.m. Eastern Standard Time. Take care, everyone, and I'll see you all in the next video.